Okay, picture this. If you walked up to a complete stranger on the street, right, and just handed them a dirty, half-smoked cigar butt you found on the pavement, they'd probably call the cops. I mean, it's gross. But what if I told you that exact disgusting habit is actually the secret framework that built a $100 billion empire? Crazy, right? You see, most people look at investing like it's a trip to some glamorous casino. They want the flashy tech stocks, the overnight crypto millions, or the trendy AI startups. But the absolute greatest investor to ever walk the earth, he didn't make his fortune by predicting the future or inventing some fancy new piece of technology. Nope. He did it by looking for the absolute ugliest, most forgotten trash on the entire market and just squeezing every single cent out of it. We're talking, of course, about Warren Buffett. So, look, I get it. When I first started working as an analyst in the banking industry, I totally thought wealth building was all about complex financial modeling, high-frequency algorithms, basically outsmarting everyone in the room. But the deeper I got into the actual mechanics of institutional money, the more I realized something pretty profound. The real masters of the game, they keep things dead simple. In fact, Warren Buffett famously distills his entire multi-billion-dollar playbook into just two foundational rules. Rule number 1, never lose money. And rule number 2, never forget rule number 1. It's really that simple. But how do you actually execute that when the stock market constantly feels like a chaotic roller coaster? Well, today we are breaking down the exact 4 rules of the money game that allowed Warren Buffett to beat the system, and how you can use them to build your own financial fortress. We'll be looking at how to master the cigar butt strategy, shift to great companies, find the economic moat, and reverse the trap of fear and greed. Let's start with rule number 1, master the cigar butt strategy. To really understand this, we have to go way back to when Buffett was just this introverted 21-year-old kid, a guy who was so nervous he'd literally throw up before speaking in public. He was studying under Benjamin Graham, who's known as the father of value investing, and Graham taught him a very specific method. Imagine you're walking down the street and you spot this soggy, discarded cigar right there on the ground. It looks terrible. Absolutely nobody wants it. But it has exactly 1 puff left in it. You pick it up, you light it, and well, while it might not be a very glamorous experience, guess what? That final puff was completely free. Now, translate that to the stock market. A cigar butt is a company that just looks absolutely terrible on the outside. We're talking maybe a failing textile mill or some struggling regional department store. The public is totally panicking, and they're selling the stock for dirt cheap. Let's say $7 a share. But when you actually look closely at the company's balance sheet, you realize something. If you literally closed the doors today and sold off all the factories, the land, and the equipment, the liquidation value is actually worth $11 a share. You are essentially buying an $11 bill for $7. That initial bargain purchase makes the entire upside completely free. And when Buffett started his very first private investment partnership back in 1956, working out of a spare bedroom in his house, this was his exact playbook. He honestly didn't care if a company was popular or cool. He just looked for math that was heavily stacked in his favor. By hunting for these unglamorous, deeply undervalued cigar butts, he managed to grow his tiny little partnership into millions of dollars. So what's the takeaway for you and me here? Stop chasing hype. Stop looking for the hottest, most hyped up investments that everyone is constantly talking about on social media. Instead, look for the assets that are fundamentally sound but are just temporarily mispriced because people are panicking. Which brings us to rule number 2, shift from fair companies to great companies. Now here is where almost everyone gets tripped up. The whole cigar butt strategy. It works brilliantly when you're playing with small money. But as Buffett's wealth massively grew in the booming 1960s, well, those cheap puffs completely dried up. In fact, he actually accidentally bought a struggling textile company called Berkshire Hathaway out of pure spite. Seriously, just because the owner tried to cheat him out of a few cents per share. It turned out to be a massive mistake, and suddenly he was stuck owning a dying business that was just burning through cash. Enter Charlie Munger. Munger was Buffett's brilliant business partner, and he gave him a piece of advice that literally changed the entire trajectory of his life. He told him, forget buying fair companies at wonderful prices, start buying wonderful companies at fair prices. Think about it. This is a massive mental shift. Instead of digging around for a dying business that has just one last free puff left in it, you start looking for a pristine, dominant business that you'd want to own forever. It's kind of like real estate. You could buy a rundown, structurally damaged house in a bad neighborhood just because it's cheap, right? That's your cigar butt. Or you could pay a fair, honest price for a beautiful, well-constructed home in the absolute best school district in the city. That is a wonderful company. Over 30 years, which one do you honestly think is going to compound your wealth safely? The wonderful house. For sure. Every single time. Moving right along to rule number 3. Look for the unbreachable economic moat. So once Buffett shifted his whole philosophy to buying wonderful companies, he needed a very specific test to actually identify them. Think of it like medieval times, okay? A castle is protected by a wide, deep ditch filled with water, which we call a moat. The wider and deeper that moat is, the harder it is for an enemy army to attack the castle. Well, in the modern business world, your company is the castle, and your competitors are that invading army trying to steal your customers. An economic moat is essentially a structural competitive advantage that makes a company virtually untouchable. Take Coca-Cola, for example. Buffett famously fell completely in love with the company and bought 7% of the entire business. Why? Because Coca-Cola has a massive psychological moat. I mean, it's been around for over a century. It has billions of dollars of brand loyalty just baked into human culture. If you gave an entrepreneur $100 billion right now and told them to go destroy Coca-Cola and steal their market share, they literally couldn't do it. The brand infrastructure is just too deep. Another massive moat Buffett discovered was the insurance business. Companies like Geico, they operate fundamentally like a bank. Millions of people pay their insurance premiums every single month. And because most people don't get into car accidents every day, Geico just sits on this giant mountain of cash that hasn't been paid out in claims yet. This cash is called the float. Buffett realized he could take that giant, completely free reservoir of insurance float and use it to go buy other great companies. It was the ultimate wealth compounding machine. So when you are out there looking to invest your hard-earned money, whether you're buying individual stocks, index funds, or even starting a side business, you've got to ask yourself, what is the moat? Is this just some flash-in-the-pan trend, or does this asset have a real structural advantage that's going to keep competitors away for the next 20 years? And finally, rule number 4, reverse the trap of fear and greed. You know, the ultimate secret to how Warren Buffett consistently beat the stock market, where millions of brilliant people completely failed, it isn't intellectual, it's emotional. Our brains are hardwired for tribal survival. And in finance, this translates into a truly devastating cycle. When the market is booming, the herd gets incredibly greedy. People see their neighbors getting rich, so they throw all their life savings in at the absolute peak of the market. Then, when a recession inevitably hits, panic sets in. Out of pure terror, people sell their investments at the absolute bottom just to stop the bleeding. They end up buying high and selling low. It's a total trap. But Buffett? He did the exact opposite. His most famous piece of advice is so simple but so powerful. Be fearful when others are greedy, and greedy when others are fearful. To put that into perspective, when the market was wildly overvalued back in 1969 and everyone was just celebrating, Buffett did something that looked completely insane. He shut down his entire investment partnership. He gave his clients their money back, and he just walked away because he absolutely refused to buy overpriced stocks. He just sat on cash. And then, when a massive crisis hit and everyone else was terrified, he stepped right in with his mountain of cash and bought world-class companies for literally pennies on the dollar. Which brings us to the Wealth Compounding Playbook summary. Building true multi-generational wealth really isn't about chasing complexity or trying to predict the next volatile market swing. It simply comes down to 4 fundamental rules. 1. Look for value. Never buy an asset for more than it's fundamentally worth. 2. Prioritize quality. Focus on wonderful assets you'd comfortably hold for decades. 3. Identify the moat. Only invest in things that have a clear, sustainable advantage over their competition. And 4. Master your psychology. Disconnect your emotions from the crowd. At the end of the day, you really don't need a high-end finance degree to act smart with your money. You just need to stay incredibly disciplined, live below your means, and let compound interest do the heavy lifting. Thank you so much for joining me for this explainer, but before you go, I want you to ask yourself this. When the next inevitable market crash happens and the entire world is running for the exits in sheer terror, will you be selling your assets to the panicking crowd, or will you be the one sitting on a mountain of cash waiting to buy their castles for pennies?